One of the first things we have to know is that the Accounting Standards Update 2014-9, that was the pronouncement that came out with the new revenue recognition rules. And it's now going to be housed in the codification at 606. I always like to remind people that there's 5 steps, and those 5 steps are going to be a very simple mnemonic that we use in our CPA review course. We say, I am a star when I recognize revenue. The I, we identify the contract. Then the S is separate the different performance obligations, the stuff you have to do. Then the ST, the T is the transaction price has to be determined. Then STA, you allocate that transaction price back to the stuff you're going to do. And then the R, you recognize revenue, either at a point in time or over time. So I am a star when I recognize revenue. A couple of fundamentals that you want to be aware of. First of all, we do have to identify the contract. There has to be an enforceable contract. And by the way, there was a very unique ASU that came out back in 2016. It was 2016-12. And 2016-12 came out and it said if you don't have an enforceable contract, then the only revenue you're permitted to recognize is revenue that you've collected the cash, you've performed the service, and that cash is not refundable. That's a pretty harsh rule if you don't have what we would consider to be an enforceable contract. So identifying the contract is really important. A couple of other small points that should be brought out. You have to make sure that there aren't multiple contracts with the same customer. A lot of times the lawyers try to beat the system. They say, oh, you're going to do a lot of stuff for your customer. You're going to do A, then you're going to do B, then you're going to do C. Well, rather than having to defer revenue until the last item is done, the rules of conservatism. Thou shalt not recognize any revenue until the earnings process is virtually completed. What they ultimately try to do is they say, let's have a separate contract for A, a distinct and separate contract for B, and a third separate and distinct contract for C. Therefore, they think they have beaten the system. But of course, we have a very simple rule: substance over form. What we say is, if these contracts were entered into near or at the same time with the same customer or a related party, and they either are negotiated as a package with a single objective, or the amount of consideration in one is dependent on another, well, then we're going to sit there and from an accounting point of view, we're going to put them together. We're going to pretend they're one contract, and then we will separate them under the accounting rules, not the legal rules. That's a hugely important area. And then one other item that came out here, as I mentioned just a few moments ago, 16-12. Just remember that one regarding collectability. And it stated that if you do not meet condition number 1 of having an enforceable contract, then you're going to have to look at the idea of only cash collected. So it clarifies on how and when an entity performs its assessment of collectability and narrows the definition of collectability being probable. There's our, our sacred cow. It has to be collectible, probable. It also includes new guidance from recognizing revenue on non-refundable consideration received when the contract fails to meet the collectability threshold. It clarifies that in this case, what you're going to do is you're going to wait until you have the money, you perform the service, and of course, that you don't have to refund it. So that's some of the fundamentals of just the first step. Then, of course, there are the other steps, which I hope we'll have a chance to talk about in our next session.